We talk about emerging managers. Does that encompass also diversity, having minority or women-owned firms, either in an informal approach or perhaps even formal? And I say this in the context because in my previous role, we actually had a diversity inclusion type of program, but it was not a sub-portfolio. It was just part of the overall.
I'd say our approach is informal. I think we view our role as fiduciaries as encompassing that, in that I think it's essential for us to take a comprehensive view of the opportunity set, and that, obviously no one, we hope to get the best returns, period. And I think that we want to, like I said, get the fullest possible view of the opportunity set in pursuit of that. So no one should be excluded for irrational reasons, and no one will be included also for anything other than risk-adjusted returns expectations.
So ours is very informal, although we think about it a lot. I've been doing this for 15 years. It's very hard to find female-run hedge funds, and so the choice has not been great. I'm not quite sure why that is, but I also don't see a lot of females in the ranks at existing hedge funds. So I'm guessing, that's not going to change quickly.
Mm-hmm.
And I think we're very much the same. It's informal, and a question I asked very early when I started to get to know the foundation was, talk to me about mission-driven investing and other ancillary things around that. And it was very clear to me that was not a priority. Mm-hmm. And the president, in no uncertain terms, said, the mission is our mission. So you guys are here to make money. So everything we've done has been to think about those things. Anything related to real estate, is it LEED certified, and are you doing those sorts of practices? But it's not key or core to the mission. So.
But it does get added as part of the review or set of values and priorities, because I'm hearing that more around impact investing and ESG, and this question comes up again. Well, it repeats the hedge fund, the first thing, which is where are all the women, and then it's where is all the impact investing. There's such opportunity potentially with the dollar flow, but it hasn't quite moved. The field hasn't moved, isn't quite there yet.
Well, it's great if you can do good things and make money at the same time, and I don't think anyone would be against that, but you can't always find that commonality. Mm-hmm.
And those opportunities are generally in closed-end fund vehicles too, I think. It's a lot less common in the hedge fund world.
Fair enough. In the opportunistic bucket, I think what Stuart had earlier this morning, I like this idea. It's opportunistic. It's kind of a free-for-all. You can do as you wish to find the best returns per unit of economic risk. Are there thematics that you care to share, or maybe you don't want to share, but you can put people on other routes away from what you're looking at?
It's funny, I really enjoyed Stuart's presentation earlier, and I think that our approach is actually extremely similar to what he described in terms of really looking hard for orthogonal return streams, with the added complexity that we're also running portable alpha, so most of our public equity beta is synthetic, and so we have an absolute return pool that's then collateralized to fund that. But I think that the approach that he outlined is very, very similar to what we're doing. I think it's a benefit of being the size that we are. That we're big enough to have institutional scale, over $1 billion under management, but small enough to really move the needle with some pretty esoteric strategies. And we're doing a lot of that. One example I think he mentioned that we're also very active in is litigation finance.
Oh, okay. We stayed away. We just couldn't get our heads around it, but we're intrigued.
Well, boards don't like it because most boards have been on the receiving end.
Yes, correct.
But it's a benefit of having discretion at the team level.
Yes, I'm envious.
So while we don't have strategy allocations, I would say the one place we've made a lot of changes is in our long-short portfolio, where we're moving away from US to Europe and Asia. We just think that smaller funds earlier in their life cycle just have a much better shorting opportunity. So that's the one space we've made a lot of changes.
And I guess we moved away from the asset class silos 10 years ago. So I think Stuart's presentation, again, was very similar to how we think about certain things. I did have to laugh, though. on one of his slides when he put wine futures. And just to digress a second, early on when I first moved to the institutional side and was managing the endowment for the largest Baptist university in the country, it was at a conference, and the very last presentation was on a firm that was buying wineries in just a little north of here. And so they, of course, had the spread with, the reds and the whites and everything afterwards. And the managing partner walked up and said, so are you interested in, joining our wine fund? And I told him who I was with. It's like, see ya. Turned around and walked away. So there are some things that occasionally you might not be able to take advantage of. But I think the concept of doing things that are uncorrelated to the markets and have a very interesting return pattern, makes sense to be looking at in this environment.
As you say that, I'm thinking, are you willing also to go deep into emerging or frontier markets?
What we had when I got to the foundation was an uber-concentrated U.S. portfolio. We had almost nothing overseas. So we've been working toward that, but it takes time. Mm-hmm. So we're still a little underweight what we'd like to be in emerging and frontier, but the first half of this year has been several international trips, and we're working toward that. So we want to move to be less dependent on the U.S. and more, again, Asia and Europe are the focuses.
Okay.
And we have emerging and frontier, but frontier only in the long-only space, so not in the hedge fund space.
Mm-hmm.
We have emerging and frontier exposure, and I think we're actively working on establishing more direct relationships in those markets too.
Yeah, and we were also in that space and also moving also in the privates as well. Yep. So I'm mindful of the time. I'm going to toss it out to the audience as we were having this discussion. If there's questions that are coming up around your own portfolio, or you want to debate us on anything, fair enough. Well, I'll leave it at that. Thank you. Join me. Oh, wait, there's a hand.
One in the back.
And he's going to debate us and say we're wrong.
Oh, boy.
It's really, for everyone.
Peter?
Yeah.
Oh, hi.
We know each other. So you mentioned something about your donations maybe being levered to, oil. And you don't hear that too much, right? But to some extent, when people talk about diversifying portfolios, especially as the hedge fund type people or people doing hedges, some of that is somewhat predictable. I know it's got to be episodic for an endowment, but also for foundations, how much grant activity there is may depend on various things. And people do all kinds of simulation and risk management and scenarios on the asset side. And of course, insurers do asset liability matching. But do you guys want to talk any more about that and whether there's something you're actually doing there, or is that just sort of a qualitative observation?
Well, so two things. One, it's interesting. I came from Helmsley Trust in New York before, and there were two interesting facets of that experience. One is that when I joined, the real estate was still being liquidated. So that was the one asset class that we didn't need to buy more of, because it was still massively, if you viewed the organization as kind of the estate that was still being liquidated in the foundation, even though there was no real estate in the foundation yet, viewed holistically, we were massively overweight real estate. So that had obvious implications for how they built out the portfolio. And then another thing, I think, is that because the programs at Helmsley are overwhelmingly healthcare oriented, your purchasing power is on a different decay line than maybe a kind of CPI plus anything. So there's something that we thought about, and I think that we were pretty active investing in healthcare as a way to try to harvest some of the returns to lever that against the cost side of the organization. At Texas Tech, I think that the oil exposure is interesting in that the donations do correlate with WTI. At the same time, I think that our committee and our alumni base puts us in a position to have some information advantages investing in energy. And so we have taken advantage of some of that selectively. But I think that we are very cognizant of that exposure, I think, kind of at the portfolio level. But it's still, I think, when there are cases where we have an information advantage, it would be almost irresponsible not to leverage that. So we try to do both. So we try to make sure that we don't let the exposure run away from us, but when we're able to have an advantage, we try to exploit that.
Any other? Yes? There's a question in the back.
Just a question on the portable alpha. What is it you're porting, and is it your hedge funds over your treasuries or fixed income instruments?
So I would say that it's an absolute return pool, so it's bigger than, it's mostly in hedge fund structures, but the underlying assets are pretty wide ranging, and it's really absolute return strategies. And then that's collateralized to fund, it's ported onto the ACWI. And so the defaults to be kind of on the Delta One futures line, and then catch skew opportunistically, and that's usually at the country level, which then you have to true up the exposure back to the index. But we do all of that internally.
Were there any other questions? No? Please join me in thanking the panel for sharing their experience.